there should be a progression in your head of, okay, I understand if I want to be long or short my stocks, but then you have to take that a step further and say, okay, is the market obvious? Because what's ultimately going to end up happening is you can absolutely make trades in your individual stocks. However, if the market is an obvious long or an obvious short, now we want to put a caveat on it. Coming into the day, the market wasn't an obvious long or short. We're kind of going sideways, we're flip-flopping back and forth. But then after the market opened and we had a direction above or below the opening price, after that point, as a day trade, the market was clearly a short.
Okay.
So nothing wrong with taking the individual trades that have an obvious bias, room to go, and they're following through. But prior to getting to that spot where you're saying I'm taking X trade, you have to say to yourself, is the market obvious? And let's just use today as an example. If the market is obvious today, which we also know that's the most finite time frame, we'd obviously like to see momentum and order flow in front of that, but let's just use below the opening price today. Then the first thing you should say is which of my stocks are doing the same thing, so I have that extra juice from the market, which kind of had in BWLD. And then we even take that a step further, because then you're going to say, well, Cat's breaking out, Amazon's breaking out, and I know I can put on longs in these positions because I came into the day saying I want to be long, and those stocks are following through. Like you said, both of those followed through well. You put the positions on, but now your trade management's different. You can put on the long even though the market's weak because the stocks are strong, but you'd probably reduce your leverage a little bit, and you would be a little bit less inclined to be looking to build a position because the market's getting hammered. So you wouldn't necessarily bail on the first momentum that slows down, but you would absolutely have a tight trailing stop in there because the long, even though it's the right long for the stock, is trading against the market. So you have what's the market doing, which of my stocks are doing what the market's doing. Then you break it down. You take those stocks first. You can still put on the other trades, but you have to recognize the trade management is going to be different because the market's completely in the other direction.
Gotcha.
And actually put a label on that kind of. I mean, that's almost what hedging is. I mean, if the market, if you're hammering the shorts on a day like today, and again, hammering is relative. If you're short and that's the right trade, but you have other longs that are still strong, that's what hedging is. You're putting on your longs in a weak tape. You cover your shorts, and then if the market should happen to bounce, now you got good position in the longs, and those longs should be the first ones to explode. And you've already built, what people might call their tier one long on a good position that was long. Which, look, quite honestly, we've had a lot of that over the last couple of months, where the market sells off and then rallies and moves back in the other direction. And that's the whole point of hedging. That's a whole nother. It's not really another strategy as much as taking it down that level where you can still take those longs in a weak market. You're just recognizing what's going on in the tape, maybe being a little bit less aggressive with share size, but still putting the trade on.